Hello everyone. I hope all of you must be fine and you must be enjoying all my videos, the previous videos which I have released over a period of almost 1 week or so. And be in touch with that. I'll be very consistent in releasing all my videos on the subsequent topics ahead. So the topic of the day for the day's discussion is the Indian money market or the financial market with specific reference to the Indian economy and its linkage with the economy, more importantly. So, you know what? The invention of the money has been one of the revolutionary idea in developing the whole business that we are looking into. Okay, because before that, in the barter system, a lot of difficulties were faced by the businessmen, and it was not up to the mark for whatsoever reason. So now we are able to actually correlate in more vigorous terms all our activities and the business activities are going like never before. So we will be discussing today about the context and relevance of the Indian money market or the financial markets, its types, its the subdivisions of the submarkets, what we call it, and we'll be discussing and deliberating on all these small points that may be asked in terms of small questions in your forthcoming examination. So hi, I'm Professor P.K. Pathak and I'm going to discuss in complete details about the Indian money market or the financial market, and you will know after the discussion as to what is the money market, what is the capital market, what is the difference between them, what are they actually specifically refer to, and how can you make full use of it, who are all the beneficiaries, and how it is helping into the upliftment of the country's economy. Okay, so before we proceed into our discussion, I urge all of you to do like, share, comment, and subscribe to my YouTube channel and keep on receiving interesting videos on very important topics of concern for your examination. And also, I have been always telling all of you that although this has been tailor-made for the people who are preparing for the RBI grade B phase 2 examination, this is equally important for all those management graduates or the one who are pursuing MBAs. So, irrespective of what domain of knowledge you are pursuing, you can get benefited by just listening to my video, and you can make your own inferences, important inferences, on the basis of the kind of discussion that we are going to have very shortly. So, okay, I'm going to now share my slide, and we will proceed with our discussion as usual. I hope all of you can see this slide. This is the topic of the day: Indian money and the financial markets, and what is the linkage with the economy as such. Let us now know what is the financial market. It's basically an economy where the funds are exchanged between fund surplus and the fund scarce individuals and the groups. So you must be aware that there are people in the society who are having the surplus fund and they do not exactly know how to make use of that. Similarly, there are people with brilliant business ideas, but they do not have adequate money to pursue their business ideas and convert them into the dividends. So, to be very fair, these two people, since they do not know each other, there is no degree of trust among each other, and so therefore there is no possibility of exchange between them directly. So here comes the financial institutions or the financial market, if we may say so, which facilitates both of these people, by rewarding to the ones who are having the fund surplus with a fair rate of interest, and also dispersing the money to the needy ones who require them for their business investment, and charging, a higher rate of returns. Okay, so this transaction is also based on either interest or the dividend. And you must know that in nowadays, every economy's financial markets are divided into two distinct segments, and one is catering to the needs of the short-term funds, while the other is catering to the need of the long-term funds. So, what we refer to the short-term fund, it's anything below 1 year. So, up to 364 days, we call it as short-term funds, while anything beyond, I mean, more than 365 days, we call it the long-term. So for these two requirements, we have two distinct areas. The one is the money market, which refers to the short-term financial market, whereas the capital market refers to the long-term financial markets. And as the concept is already clear, up to 364 days, the money market looks into, and beyond that, it's the domain of the capital market. So let us explore further about the financial market. Basically, financial market is a market where the financial assets are created and traded. How you can create the financial assets? So, in case you have established a business, firm, and you do not have adequate money to actually begin your operations, what you can do is the owner's capital, what the owner is supposed to put into the business and do not have it. So, a part of that can be converted into shares, and that can be floated among the people so that the money is generated in the process. So in this process, money is being pumped into the business, while the people who have bought the shares, they become owners of the business for that particular proportion of the company. So it's a win-win situation for all. So basically, financial market exists wherever there is a financial transaction of any kind with specific reference to the business activity. Okay. Okay, all of you must also make certain notes, small points, because these are going to be very handy for all of you in all your future references. One-liners specifically. So let us know the basic concept of the financial markets, which already I have told you in a part in the previous slides. So it consists of the two major sectors. One is the household, which are saving money, and then there are business firms, they invest. Okay, so what the financial market is doing, this acts as an intermediary between these two people, one who is saving money and the one who requires it. So what it does, it directs or allocates the available investment funds to the most productive investment opportunity. And if it has been well performed, it will result into a higher rate of return to the households, and limited resource will only be given to the firms which are having the highest productivity in the economy. Okay, and then there are two major alternatives, for these even households. They can either go to the banks where they are getting the fixed rate of interest, or if they have the method to take certain element of risk, they can directly go into the financial market and they can buy a company share of the debentures and may take more benefit in the process. Okay. And this process of allocating fund is known as the financial intermediation by the financial agencies. And the banks and the financial markets compete as intermediaries. Okay. Now let us see what are the types of the financial markets. It can be broadly classified into the organized market and the unorganized market. Okay. Organized market can be further subdivided into capital market and the money market. Okay, so while money market is having this kind of instrument like the call money market, the commercial bill market, discount market, treasury bill market, and the acceptance market, which we are going to discuss in detail in the next slides. On the other hand, capital market can further be subdivided into two parts. One is industrial security market, which is bifurcated into the primary market and the secondary market, and the second one is the government security market. So this is about the organized market, and parallelly, we have the unorganized market, which we can refer to the indigenous bankers, the money lenders, the local bankers who give loans to the needy one who do not have any credential as such, and then there are some pawn brokers. So now we'll see it one by one. What is the difference between organized sector and the unorganized sector? As all of you must be knowing, the organized sector consists of the RBI, the SBI with its 7 associates, all the nationalized and commercial banks, other scheduled and non-scheduled commercial banks, foreign banks, and regional rural banks. Okay, so these are the organized sector which are having their perfectly matched ecosystem, and all the things are being done as per their specified policies. We also have certain non-bank financial institutions like LIC, GIC, and the subsidiaries. Then there are certain quasi-government bodies and the large companies who make their short-term surplus funds available to the organized market through the banks. And we also have the cooperative credit institution that occupy the intermediary position between the organized and unorganized parts of the Indian money market. Okay. And on the other hand, we have the unorganized sector, which do consist of the indigenous banks and the money lenders. And the important thing is that the activity of its parts are not systematically coordinated by RBI. The Reserve Bank of India is nowhere concerned, or it has got no prerogative to control the activities of these agencies. Even the money lenders, they operate throughout the country, as you may know it, but they do not have any kind of linkage among themselves. Unlike the organized sectors, which do have certain linkages among them. Now let us come back to the organized markets. There are two organized markets. One is the money market, the other one is capital market. And as I told you, the money market is concerned with the short-term credit transactions, while the capital market is about the medium and long-term credit and financial transactions. Unorganized markets are those that are not governed or controlled by the central bank. I already told you that RBI has got no prerogative to control of these people, and so therefore we exactly do not know what actually is going through them, and even these people are not able to capitalize to the maximum or the optimum level. Actually, and what are the functions of the financial markets? They mobilize the savings because otherwise, if these institutions are not there, the common household, they will keep their money stagnant at their home, which will not result into any kind of return on the asset. While also the businessman will be deprived of, getting adequate funds in order to promote their business. So these are the markets which do mobilize the saving, the transfer of the saving from the savers to the investors, and it provides variety of the investment options as well. And the next function is the facilitating price discovery, because when you take out your savings and put it into the market, you exactly know what is the price of your investment. Otherwise, there is no price. It will be having the same amount over and over a period of time. It also provides liquidity to the financial assets. Okay, because they are very simple, to buy and sell, and so therefore these asset holders can easily sell their financial assets using the financial markets mechanism and convert into the cash. And in the process, the financial markets do reduce the transaction cost because a lot of information is available at single window or very limited, places, thereby saving a lot of time, effort, and money on the part of the buyers and the sellers both. Okay. So finally, we can say that the financial market therefore serves as a common platform where the buyers and sellers can meet to fulfill their individual needs. Let us proceed further and discuss about the money market instrument. These are some of the instruments like the Treasury Bill, the call money, the certificate of deposit, commercial bills, and the commercial paper. These have been adequately discussed in the following slides. We'll just be touching it up so that you are getting conversant with the topics. You see, the call money. Call money is basically happens among the banks. So what happens there is the bank with the temporary deposit of the funds from the demand side, and the bank with the temporary excess of the fund, they form the supply side. The SBI always remains on the lender side. It does not have to take money from as a demand side. It operates through the brokers who always keep in touch with the banks and establish a link between the borrowing and the lending banks. And this, call money market is very sensitive and competitive markets. And usually this call money is granted only for 1 day. So you can just imagine what is the significance. Okay. The rate of interest in the call money market is also highly unstable because if you got, the factor of the demand and supply comes into place here, and on any given day, if the demand is small, definitely the rate of interest will be very high. And the call money market also plays a very vital role in removing the day-to-day fluctuation in the reserve position of the individual banks. Because in case the reserve position of any bank is not healthy, it can indulge into this call money market and make use of it in order to compete with their counterparts. Let us talk about the treasury bills. These deal, which are short-term liability of the government of India. So basically, what happens is these bills are issued to meet the short-term financial requirement of the government in principle, but in reality, what happens is they have become a permanent source of the funds to the government. And what happens is because every year, a portion of these treasury bills are converted into long-term bonds. So while basically they were created for the short-term requirements, after converting, they become for the long-term bonds. Now, these treasury bills are of two types. One is ad hoc and the other one is regular. Ad hoc bills are issued to the state governments or the semi-government departments and the foreign central banks. They are not sold to the banks and the general public and are not marketable because they just have been created to look for a temporary arrangement of the funds. Whereas the regular treasury bills are sold to the banks and public and they are fully marketable. Okay. And one common thing is that both the ad hoc and the regular treasury bills, they are sold by the RBI on behalf of the central government. So we have already covered up the call money market and the treasury bill market. Now we'll proceed to the commercial bill market, which is issued by the corporates. So this is basically a promise to pay a specified amount by the buyer of the goods to the seller of the goods. So what happens is the seller will sold his goods on credit, draws the bill and sends it to the buyer for acceptance. And after the buyer or his bank writes the word accepted, it becomes a marketable instrument. Now the seller can sell this particular bill either to his bank for the cash, or it can also sell this. These banks also can sell these bills to other banks to get them discounted from the RBI. Next is your collateral loan market. These are backed by the security. Okay. So what happens is the short-term loans can be procured against the government securities, shares, and debentures of the governments, etc. So these are fairly safe, markets. Then there is a concept of the certificate of deposit or the commercial paper markets. So you must be very particular and you must understand the relevance and the difference between these two. Let us start with the certificate of deposit. It can only be issued by the scheduled commercial banks in a multiple of rupees 25 lakh each. But the minimum size of the issue must be 1 crore. And the maturity level will be 3 months to 1 year. It will be issued at a discount to face value and the discount rate will be fully determined as per the market. On the other hand, the commercial paper, it can be issued by a listed company which has a net worth of at least rupees 10 crore. So it is only for the companies beyond, above 10 crore rupees net worth. And also having a working capital limit of at least 25 crores. So the commercial papers can be issued in the multiple of 25 lakhs each and again subject to a minimum of the issue of rupees 1 crore. The maturity could be from 3 months to 6 months, freely transferable by endorsement and delivery. Okay. And the important thing is that the company saying the commercial paper will have to obtain every 6 months a specified rating from an agency approval by the RBI. And unless and until the company is having a fair amount of rating, it cannot issue the commercial paper as such. Okay, so that's about the certificate of deposit and the commercial paper markets. Now we'll proceed into some other concept like participant in the money market, and these are the participants. You can go through the whole content. The central government is definitely one. Then the PSUs, public sector undertaking, which are as listed companies, the government companies, they can issue the commercial paper. And usually, if these PSUs, even first of all, they do not have surplus money in most of the cases. But even though if they have, they are very inefficient and they do not actually believe in investing as such because of the conventional mindset of the managers. And there are the insurance companies which are important players. Then mutual funds. These schemes ensure highest liquidity to the investors. Then there are banks like commercial banks, which are big borrowers and lenders in the money market. They borrow and lend in the call money market, short notice market, repo and reverse repo rate. So you must know what is repo and reverse repo rate. Repo rate is the one at which the RBI it lends money to the commercial banks. Okay, that's the basic rate of interest. And reverse repo rate is the rate of interest which is given to the commercial banks when RBI is taking money from them for certain requirements. And another important players are the corporate, which do issue the commercial papers. And there are many other significant players in the non-banking financial companies as well. So you can make small notes out of this, and you can just make certain inferences for your future references. Now let us till now we were looking into the money market instrument. Now let us look into the capital market instruments. So there are basically three types of capital market instrument. The one is the pure instrument, which are do not have anything in common, like share, bonds, and debentures, which are the example of the pure instruments. Here, just now I told you. And then there are bonds and the debentures, which adequately I have this topic I have covered in my one of the previous video. If you refer to my video channel, YouTube channel, uh, the management guru at the rate Professor Pradip, you will see I already have discussed at length about the shares and debentures in a specific video, I think last month. You can just search out and take inferences from that particular video about the shares and debentures and the preferential shares. Okay, hybrid instruments are a combination of the characteristics such as the bond and the equity investment, while the derivatives they do not have any intrinsic value and they are derived from one of the more financial assets. In this, what we do is we try to collaborate with another agency and having made certain anticipation, we agree to buy or sell at a future date on a fixed price. So irrespective of the variation in the price later on, whatever was arrived at and agreed upon 10 days, 50 days or back, on that particular date, the business will happen at the same rate. So this is about the derivative. Stock exchanges, you have some little bit of idea about the exchange. This provides a marketplace for sale of existing purchase and sale of existing securities. It facilitates the conversion of the security like share and debenture into money and vice versa. It assists companies in raising capital, providing liquidity and investment security to the investors. And it is controlled by the Securities Contract Act of 1956. And as for that, the definition is what anybody of individual, whether incorporated or not, established for the purpose of assisting, regulating, or controlling the business of buying and selling or dealing the securities, we can call it the stock exchange. Okay. Finally, concludingly, we can say that financial markets facilitate the efficient flow of investment and savings in the economy, and the right mix of financial product and the instrument as well as the financial markets and institutions fuel the demand of the investors, receivers, and a country's overall economy. So this is one of the significant aspect of any growing economy in the world. And what the investors can do, they can specialize into specific services. And the markets we're using the financial markets like bond and stocks, the instruments like derivatives, bank CDs, certificate of deposits, and the futures, and the institutions like the bank, pension funds, insurance companies, etc. So that's it. I hope you have got fair amount of idea about the money market and the financial market, and now you must be having fair amount of idea as to what is the short-term money market and what is the long-term market. Short-term is being catered by the money market, while the long-term needs are being catered by the capital market, and both has got distinct, instrument, and people get benefit as per their requirements. So that's it for the day. I hope you have enjoyed, and I thank all of you for being courteous to be watching my video till the last slide. And I expect all of you to understand all the basic concept. However, in case you got any difficulty, you can get in touch with me. You can write to me on this my mail ID. I'll be more than happy to clear your doubts on any of the topic. In case you got another subtopic which are not being covered, or being a management expert, I can also discuss on some of the important managerial topics. So you can just advise me on which managerial topic you would like to have a discussion of this kind. Okay, so that's it for the day. And now I stop sharing, and I urge all of you to do like, share, comment, and subscribe to my YouTube channel. Be in touch with me, keep following, and we will be fetching a lot of benefit in terms of your examination preparation, in terms of your enhanced knowledge, and in terms of your enhanced capability of the competence. Okay, so that's it for the day. Hoping for all of your best of the preparations in the forthcoming examination, and wish you all the best. Thanks a lot once again, and have a nice day.